Welcome to the Retirement Wealth Podcast. We're so glad you're here with us today. You know, one of the biggest concerns for folks planning for retirement is how to create a steady income stream. And today, we're diving into an exciting topic that can help with that: how to use dividend stocks for monthly income.
That's right, Emily. Dividend stocks can be a powerful tool in your retirement planning arsenal. They not only provide potential for growth, but also a reliable income source, which can be crucial when you're living on a fixed income.
Absolutely. We're going to discuss what dividend stocks are, how to select the right ones for your portfolio, and some strategies for managing them effectively.
Plus, we'll touch on common pitfalls to avoid, and how to ensure your investments align with your overall retirement goals. And trust me, you won't want to miss those tips.
And don't forget, we'll also share some real-life examples to illustrate how dividend stocks can work for you.
Exactly. So if you're ready to learn about making your money work for you, let's jump right into it.
Let's do it. David, could you start by explaining what exactly a dividend stock is?
You know, Emily, it's really interesting the way people are approaching retirement planning today, especially with everything happening in the economy.
Absolutely, David. I mean, with inflation rates fluctuating, folks are really feeling the pinch. They want to make sure their nest eggs can keep up, right?
Exactly. It's like just when you think you've got a solid plan in place, the landscape changes. Retirees are looking for ways to secure monthly income, and that's where dividend stocks can play a crucial role.
Right. And when you think about it, relying solely on Social Security isn't enough for most people. You know, with the potential changes looming in that system, it really makes sense to look for additional income sources.
Definitely. And it's not just about covering basic expenses anymore. Healthcare costs are skyrocketing. I was talking to a client the other day. Let's call her Linda. She's 62 and planning to retire in just a couple of years. She's worried about her healthcare expenses. It's a real concern for many.
I can imagine. So many people don't factor in those rising costs when they're mapping out their retirement budget.
Right. Linda mentioned that she's heard about rising premiums and prescription costs, and it just adds to her anxiety about retirement.
And that's where having a strategy for generating income becomes so important. It's not just about living comfortably. It's about having that peace of mind.
Exactly. You know, dividends can provide a steady stream of income, which can help to buffer against these rising costs. It's like having a paycheck come in every month, which can ease a lot of those worries.
For sure. But it's not just the immediate concerns, right? There's also the emotional side of financial security. I mean, when people feel secure financially, it really impacts their quality of life and even their health.
That's so true. I've seen it firsthand. I had another client. Let's call him Mark. He was so stressed about market volatility. Every time the market dipped, he would panic.
That sounds familiar.
Right? And it's understandable. But once we started incorporating dividend stocks into his portfolio, he started to feel more secure. Knowing he had that consistent income stream made a world of difference for him.
It's amazing how just changing your perspective on income sources can shift your entire outlook.
Exactly. And I think we also need to consider legacy planning. More retirees are thinking about what they'll leave behind for their families.
Yes, and dividend stocks can potentially grow over time, providing both current income and a way to pass on wealth to the next generation.
Right, and I think that's appealing to a lot of folks. They want to feel like they're not just living for themselves, but also setting up their kids or grandkids for success.
Absolutely. And with the current economic trends, people are realizing that they can't just rely on traditional methods anymore.
Exactly, Emily. You know, with the volatility we've seen lately, people are looking for more stable investments. Dividend stocks can be a way to not only hedge against inflation, but also provide that regular income that's so essential for retirees.
And it's important to highlight that not all dividend stocks are created equal. Some are more resilient during downturns, while others might be more risky.
Yes, and that's where doing your homework comes in. You need to look for companies with a solid track record of paying dividends, and ideally increasing them over time.
Right, so it's not just about the yield, but also the stability and growth potential.
Exactly. And I think it's also worth mentioning the tax efficiency aspect. Dividends can be taxed more favorably than ordinary income, which is something retirees should consider when planning their withdrawal strategies.
That's a great point. a little tax efficiency can go a long way in maximizing your retirement income.
Absolutely. I had a couple of clients recently who were surprised to learn how dividends could fit into their tax strategy. They weren't aware that qualified dividends could be taxed at a lower rate, which can really help in retirement.
It's funny how often these details get overlooked.
Right? And I think it's also about encouraging people to think outside the box. Instead of just relying on bonds or fixed income, diversifying with dividend stocks can really help balance a portfolio.
Yes, and it's all about finding that balance. You want growth, but you also want that steady income, especially as you get older.
Exactly. And I think that's why we're seeing more interest in dividend stocks right now. With the market being as unpredictable as it is, people are looking for ways to create their own financial stability.
It really does feel like a critical time to be proactive about these decisions.
For sure. And as we transition into discussing some core strategies, it's important for listeners to understand that these aren't just pie-in-the-sky ideas. They're actionable steps that can really help secure their financial future.
Yeah, I'm excited to dive into that. It's all about empowering people to take control of their retirement planning, right?
So when we talk about using dividend stocks for monthly income, it's really about understanding how they fit into your overall retirement strategy.
Right, and I think a lot of folks might be curious about how to actually get started with that. Like what's a good allocation for dividend stocks in their portfolio?
Exactly. A common rule of thumb is to aim for about 60% in stocks and 40% in bonds. But with dividend stocks, you might want to tweak that a bit. A 70-30th split can work well, especially if you prioritize income.
That makes sense. So if someone has a $500,000 portfolio, you're saying they'd want to have around $350,000 in stocks, right?
Yes, that's correct. And then from that stock portion, you could allocate, say, 30% to dividend-paying stocks. That would be about $105,000 invested in dividends.
And then those stocks ideally would provide a steady stream of income each month, right?
Absolutely. Many dividend stocks offer yields anywhere from 2% to 5%. So for our example, if you're at a 4% yield on that $105,000, you'd be looking at around $4,200 a year, or, about $350 a month.
That sounds pretty appealing. But I imagine there's more to it than just picking high-yield stocks.
For sure. Diversification within your dividend stock investments is key. You don't want all your dividend stocks to be in one sector. Think about spreading it across utilities, consumer goods, and maybe some healthcare stocks. That way you're less susceptible to market swings.
Right, and that's something that can really help to stabilize your income during downturns.
Exactly. Plus, you should also consider tax implications. Qualified dividends are taxed at a lower rate than ordinary income, which is a win for retirees.
So if someone has their dividends in a tax-advantaged account, like a Roth IRA, they wouldn't have to worry about those taxes at all, right?
Precisely. That's one of the big advantages of using a Roth IRA for dividend stocks. You can enjoy that income tax-free in retirement, which can help stretch your withdrawals further.
And speaking of withdrawals, that brings to mind the 4% rule we hear so much about. How does that play into this?
Good connection there. The 4% rule suggests that retirees can withdraw 4% of their portfolio annually without running out of money. But if you're generating income from dividends, you might find you don't need to dip into your principal as much.
So if you're pulling in $4,200 from dividends, that could cover a significant portion of your living expenses, right?
Exactly. Ideally, you'd want your dividends to at least cover your essential expenses. That way, you can leave your principal untouched for emergencies or unexpected costs.
And then, that brings us to the importance of having a withdrawal strategy, right?
Yes, absolutely. The bucket strategy can be particularly effective here. You create different buckets for your money based on when you'll need it. Short-term needs in cash or bonds, mid-term needs in dividend stocks, and long-term needs in growth stocks.
That way, you're not forced to sell your growth stocks during a market dip, which is a huge risk, right?
Exactly. By having a solid plan, you can weather the storms without compromising your long-term growth potential.
And speaking of risks, what about using annuities in this mix? Are they something retirees should consider?
Annuities can provide guaranteed income, which can be comforting. However, they can come with fees and less liquidity. It's really about balancing guaranteed income with the potential for growth.
So it sounds like a combination of strategies is often the best route to take.
Absolutely. You want to diversify across stocks, bonds, real estate, and maybe even some annuities to create that solid foundation. And don't forget about Social Security.
Right. Timing your Social Security benefits can play a huge role in your overall income strategy.
Definitely. If you can wait to claim Social Security until age 70, you'll get a significant boost in your monthly benefits. It can be tempting to take it earlier, but delaying can really pay off in the long run.
And that could free up your dividends to be reinvested or used for other expenses while you wait, right?
Exactly. It creates a nice synergy in your overall strategy.
So if someone is approaching retirement and looking at their portfolio, what should they be particularly keen on?
They should focus on their asset allocation, making sure to diversify their investments, and think about their income needs. Also, consider tax implications when withdrawing from different accounts.
And what about those common pitfalls? I imagine there are a few things people need to watch out for.
Oh, for sure. One major pitfall is chasing high yields without considering the underlying company's stability. That can lead to some serious losses.
So focusing on quality companies that have a history of increasing their dividends is key?
Exactly. You want companies that not only pay dividends, but also have a track record of increasing them over time. It's about building a sustainable income stream.
And keeping an eye on your overall financial picture is crucial too, right?
Yes, you can't just focus on one aspect of your portfolio. You need to consider your entire financial situation, including your lifestyle needs, healthcare costs, and any unexpected expenses. That way, you can adjust your strategies as needed.
It sounds like there's a lot to think about, but with the right strategies in place, it can really pay off in the long run.
Definitely, Emily. It's all about making informed decisions and being proactive in your retirement planning. That's where we can help guide people through the process.
And I think that's a great note to end this section on. Thanks, David, for all these insights.
So, Emily, one of the biggest pitfalls I see with retirees is the sequence of returns risk. It sounds technical, but it really just means that the order in which you experience investment returns can significantly impact your retirement savings.
Right, so if someone has a couple of bad years right at the beginning of their retirement, that can be really detrimental, can it?
Exactly. Let's say someone retires in, 2008 or 2009. They might start withdrawing from their investments just as the market is taking a dive. That can lead to a situation where they're selling off assets at a loss to cover their living expenses.
Ouch! That sounds tough. I can see how that would put a real strain on their finances.
It does. And it can have a long-lasting effect. I had a client a few years back who retired in late 2007. He had a solid plan, but then the market crashed. He was withdrawing money to live on, and it really set him back.
So what's the lesson here?
The key takeaway is to have a strategy that accounts for market volatility. Consider having a cash reserve or bonds that can cover your expenses for a few years, especially in those early retirement years.
That makes sense. What about the tax implications? I feel like taxes can be a big oversight for many people when they're planning their withdrawals.
Definitely. A lot of retirees don't realize how much taxes can eat into their income. For example, if they're withdrawing large sums from a traditional IRA, that can push them into a higher tax bracket.
Right, and that can be really surprising to them. I imagine people think they're just taking out what they need, but the tax bill can end up being much higher than expected.
Exactly. I had a couple who were living comfortably on their retirement income. They didn't account for taxes properly, and when they filed their taxes that year, they were shocked to find they owed significantly more than they had planned for.
Yikes! So what should people do to avoid that kind of situation?
It's all about understanding your tax situation. Planning withdrawals strategically can help. For instance, mixing income sources like Social Security, pensions, and taxable accounts can help manage tax impacts.
Speaking of Social Security, I know a lot of people claim it too early.
Oh, absolutely. Claiming Social Security benefits at 62 may sound tempting, but it can significantly reduce the monthly amount you receive for the rest of your life.
I can see how that might happen. especially if someone is eager to retire. But what if they need the income?
It's a delicate balance. I had a client who claimed early because they thought they needed the cash flow, but they didn't realize they were leaving a lot of money on the table.
So, what's a good rule of thumb here?
Ideally, if you can wait until at least your full retirement age, or even better until 70, you'll maximize your benefits. It's all about longevity. If you expect to live longer, waiting could be worth it.
That's a great point. And on the topic of longevity, healthcare costs can be another big surprise for retirees, right?
Yes, many underestimate how much healthcare can eat into their savings. I've seen it time and time again. People often think Medicare will cover most of their expenses, but there are gaps, especially with long-term care.
So what can people do to prepare for those unexpected healthcare costs?
A health savings account can be a great tool, along with considering long-term care insurance. It's all about planning ahead and accounting for those potential expenses.
And what about asset allocation? I imagine that's another common mistake.
Absolutely. Some folks get too conservative too quickly. They might think that as they age, they need to shift everything into bonds or cash, but that can limit growth.
Right. And if they live into their 90s, that could be a problem.
Exactly. I had a client who went very conservative in their mid-60s. They didn't realize that they needed their investments to continue growing to keep up with inflation over a long retirement.
So what's a balanced approach to asset allocation?
A diversified portfolio is key. Having a mix of stocks and bonds, perhaps even some alternative investments. It's all about risk tolerance and time horizon.
And speaking of red flags, are there signs that someone might be on the wrong track?
Definitely. If you notice you're constantly stressed about money, or if you're not hitting your retirement savings goals, that's a red flag. Also, if your asset allocation feels off, or if you don't have a withdrawal strategy, those are signs to reassess.
Those are really helpful tips. It sounds like having a plan and revisiting it regularly can make a big difference.
Absolutely. And don't forget to adjust as your life circumstances change, whether it's a new job, health issues, or even changes in family dynamics.
So what are some next steps for listeners who might be feeling overwhelmed?
Start by doing a comprehensive review of your financial situation. Look at your expenses, income sources, and retirement goals. If it feels daunting, consider working with a financial advisor who can help you create a tailored plan.
And remember, it's never too late to adjust your strategy.
Exactly. Taking proactive steps can really empower you to feel more secure in your retirement journey.
Well, that's a lot of great information to think about.
It sure is. And I hope our listeners take these insights to heart as they navigate their retirement planning.
Absolutely, David. It's all about being informed and making those smart choices for a secure future.
Well said, Emily. All right, Emily, so let's dive into some practical steps that our listeners can take right now to leverage dividend stocks for that monthly income.
Absolutely. I think the first thing they could do is really evaluate their current investment portfolio.
Yeah, and that doesn't have to be overwhelming. Just set aside some time to review what you already own. Look at which stocks are paying dividends and how often they do.
Right. And if they're not sure where to start, tools like Vanguard, Fidelity, or Schwab, they all have great retirement calculators and resources that can help you assess your situation.
Exactly. And if you're feeling a bit lost in all of this, SSA.gov is a fantastic resource for checking your Social Security benefits, which could play a big role in your overall retirement income strategy.
That's a great point. And for those who want to dive deeper, there are also some really useful financial planning apps out there.
Oh, definitely. Apps like Personal Capital or Mint can help track not just your investments, but also your overall financial picture. It's a good way to see where you might need to make adjustments.
And, for listeners who enjoy reading, there are some excellent books on dividend investing. The Little Book of Common Sense Investing by John Bogle is a classic.
Yes, and The Dividend Growth Investment Strategy by Jeremy Jossi is another one worth checking out. Both provide solid insights into building a dividend-focused portfolio.
Podcasts can also be a great resource. I love Invest Like the Best. They often have episodes that touch on dividend investing and income strategies.
That's a solid recommendation. And for those who prefer video, there are plenty of YouTube channels dedicated to financial literacy that cover dividends and retirement planning.
One habit I'd suggest starting right away is to run your retirement projections. Just plug in your numbers and see where you stand.
Yes, and do that quarterly. It's a good habit to check in on your portfolio and make sure it's aligned with your goals.
And don't forget about the importance of diversification. It's key to having a balanced portfolio.
Absolutely. Consider spreading your investments across different sectors and industries to mitigate risk.
And if you find any underperforming stocks, it might be time to reassess whether they're still worth holding on to.
Exactly. And there's no harm in consulting a financial advisor if you feel uncertain about your choices. It's never too late to improve your plan.
That's so true. Just taking those small, actionable steps can make a huge difference in the long run.
And don't hesitate to adjust your strategy as life changes. Whether it's a new job, a change in family status, or anything else.
Yes, life is dynamic, and so should be your retirement plan.
And remember to set up automatic reinvestment for your dividends if you're looking to grow your portfolio. It helps to build wealth over time without even thinking about it.
That's such a smart move. And for those who want to take it a step further, you could also look into tax software to help manage your investments efficiently.
Right. Understanding the tax implications of your dividends can save you money in the long run.
Another great habit is to keep an eye on interest rates and market trends. Staying informed can help you make better decisions.
For sure. And don't forget to connect with others in your community or online. Sharing experiences and insights can provide new perspectives and ideas.
I love that. Engaging with the community can really motivate you to stay on track with your retirement goals.
So those are some practical first steps to get started with dividend stocks for that monthly income.
With these tools in your pocket, you're ready to strengthen your retirement plan. Let's recap what we've covered today.
So as we wrap up, let's quickly go over some key takeaways from our discussion on using dividend stocks for monthly income.
Yeah, absolutely. One of the biggest points is dividends can provide that steady stream of income, right? It's like having a paycheck even when you're not working.
Exactly. And remember how we talked about the importance of diversification? Spreading your investments across various sectors can help reduce risk while still capturing those dividends.
Right. And then there's the power of reinvesting dividends. It's a strategy that can really accelerate your wealth over time. Compounding can be a game changer.
For sure. And let's not forget about understanding the companies you're investing in. It's crucial to look at their financial health and track record to ensure they can sustain those dividends.
And finally, having a clear plan can make all the difference. Knowing how much income you need and aligning your investments accordingly, that gives you confidence.
Absolutely. Building and protecting your retirement wealth is all about making informed decisions, staying disciplined, and adapting to changes in your life and the market.
It's really empowering to take control of your financial future. Remember, it's never too late to start planning or adjusting your strategy.
Definitely. If you found value in today's episode, we'd love for you to like and subscribe. And don't forget to comment your biggest takeaway or any questions you have. We really want to hear from you.
Yeah, and if you know someone who's planning for retirement or is already retired, share this episode with them. It might just spark a conversation that helps them on their journey.
And next time, we'll dive into how to avoid emotional investing mistakes, which is super important for keeping your strategy on track.
That's going to be a great one. Thanks for listening, everyone. We appreciate you spending your time with us.
Take care, and we'll see you next time.